Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast. And today's guest is Ravi Sood, who's chairman of Galane Gold, a gold producer and explorer with mining operations and exploration tenements in Botswana, South Africa, and the US. Ravi's an entrepreneur with many business interests, so it'd be good to hear more about Galane Gold and their future prospects and other interests that Ravi is pursuing within the mining and resources industry. So let's welcome Ravi to the podcast. How you doing, Ravi?
Fantastic. Pleasure to be here.
Yeah, and I appreciate your time as well. So you've obviously got quite an interesting background. You're an entrepreneur. I wanted to give our audience a background of your career, going back to probably when you studied and how you sort of maneuvered your way through your career to where you are today. And then we can obviously speak more about Galane Gold and other subjects after.
Absolutely, I'd love to, and maybe I'll even kind of try and focus it on how all that led me to the mining industry, which I certainly didn't start there or intend to end up in the mining industry, but the events conspired to bring me here. So my educational background is in mathematics. By training, I'm a mathematician and computer scientist. Did a degree in math and computer science, also classical history, but and intended to go to graduate school for mathematics. And I ended up deferring my admission by a year on graduate school, and sort of a strange sequence of events led me to working, the deferral was related to personal financial reasons. I couldn't put together the funding package that I needed to take me through all the way through graduate school. So I deferred by a year, and through a lucky set of circumstances, as sometimes the universe, the balls bounce in your favor, I came to work for a former professor who I'd done some work with in the past on the trading floor of Deutsche Bank. It was Deutsche Morgan Grenfell at the time. This was the late 90s. And that was not something I had any sort of previous interest in or background in. I was very academically focused. My path was to become a professor, or so I thought. And this was a detour in order to make a few bucks, so I could get back to my studies and get on to graduate school. And as luck would have it, a few months into what was intended to be a temporary work position there, yes, I did start to get interested and got a bit of the flavor for trading in the investment industry. But we all got let go, or almost the entire team in Canada and Deutsche Morgan Grenfell got let go on the trading side due to a variety of reasons at the parent company and Asian financial crisis, 1997, that sort of thing. And that took me to, again, I thought very temporarily working for a family office in Toronto, a family investment office. And one thing led to another, and I ended up not going to graduate school. I stayed with that group. It was called Lawrence and Company. And that was, you could say that's the only job I've ever had. And things just sprang from there. And I spent the next 13 years in the investment industry, ultimately as chief executive officer of the asset management company that sprung out of this family office, which I sold now 11 years ago to a public company, a larger financial institution, and moved on to more entrepreneurial activities, specifically mining. But just dialing it back and take you on my journey, I remember in the 90s, as I started to take meetings with different companies that would come through our office, pitching us buy our shares, invest in our financing, that sort of thing. Occasionally, not that often, because this was the 90s and these were the halcyon days of the internet boom, a mining company would come through. And I remember repeatedly thinking to myself, with absolutely no interest in any of these pitches, do we even mine things anymore? Is this still a business? And it was, I think, also colored by the fact that, particularly at that time, most of the people running those companies were older, and just the way cycles work, it was sort of a business that had lost a lot of popularity in the years leading up to it, and seemed to a casual observer, a layperson such as myself, to have lost relevance as well. It was all about the internet and the dot-com boom and productivity from applying different technologies and innovations. Why do we still dig holes in the ground, kind of thing? So that was my first impression and exposure to the mining industry. But then as the market changed, and we went into a commodity cycle starting in the early 2000s. As an investor, I had to take notice, and I started to learn more about these businesses, and I saw what was happening with the demand boom coming out of emerging economies, China and India in particular, but really around the world, and also the really interesting supply dynamic, where you had a whole bunch of factors conspire, improved efficiencies from technology, additional recycling, stockpiles coming from that were accumulated and built up in the former Soviet Union, which lasted for years and years and contributed a significant amount of supply to various base metals and other commodities. All of those things sort of intersecting at the same time: stockpile depletion, a lack of capex, a lack of discoveries, a lack of exploration, and a boom in demand, all hitting at the same time, as these things often do. And you had this boom in commodity prices and an explosion in value creation for shareholders of mining companies. So particularly being somebody in the investment business, running investment funds in Canada, very much a resource focused kind of country, or one with a resource background and expertise anyways, that was a lot of what I focused my time on as an investor. And you could say I got interested and enamored and fascinated with the market, with the mining market. My journey to gold was a little bit longer. I still did not have much interest in gold. I really did not understand or appreciate its role as a monetary asset. And so through that mining boom in the zeros, where yes, gold went from 250 to almost 2000, of course, in that run up, I was primarily interested in base metals, in uranium, in coal, other bulks, iron ore, etc., and focused my investments and my time there. But it was really in 2007, 2008, where again, I was forced to do so as an investor to really understand what is happening on a macroeconomic level. What does all this mean? What is the effect of monetary policy? And how does the system work? I had a person who spent all these years working in the investment industry, surrounded by all this information. And I can say with all due humility that I realized I really did not understand how the system worked. And to this day, I'm still a learner. I really still trying to figure out how it all ties together, who's pushing the buttons and pulling the levers that matter, and how does that percolate through the system. But it was really then that I came to realize that no, gold is not a shiny rock or metal as it actually is. It's something that is unique from a physical and chemical perspective, and has played this role for a very long time. And even in this digital future is going to continue to have a role that's very important, and is not understood even by people like me, who in theory are spending all of their time trying to understand things like this. And I can tell you, even to this day, I think the more educated in a conventional sense, and intellectual in a conventional sense, the person is you're speaking to, the more likely you are to be laughed at for talking about the role of gold in the future. But that's been my journey. It really started with, mining for me started in the early zeros with that mining boom as an investor, and then 2007 and 8, starting to appreciate the role of gold, and that it was also a huge opportunity. And then after selling my investment business, that gave me the opportunity to start some other businesses and sort of jump on some opportunities that I'd been thinking about for a long time. In particular, starting a gold business that would give me, as an investor and large shareholder, and ultimately all the other people that I brought in and got involved, an opportunity to participate in a very focused way in what I believe would be a huge revaluation in precious metals, gold and silver specifically. And create a lot of value for myself and for other shareholders. That's really the genesis of Galane Gold. So I started that company in 2010 with a deal to acquire a non-core asset from a company called Gold, a great Canadian mid-tier to almost major-sized gold company. One of its first production assets was the Mopani gold mine in Botswana. And with the growth of the company throughout the 2000s and that asset getting on in years, it became non-core to them on a couple fronts. It was geographically isolated in their portfolio, but also scale-wise, it didn't fit. Producing 40,000+ ounces a year to a company that was producing about 1 million ounces a year, it was just too small. It didn't make their cutoff, no matter what they could see themselves doing with that asset going forward. So it was put for sale. Based on historical relationships, I was given a shot at doing a deal with them, and in a very constructive way, carved out a deal which closed in 2011, and that was the beginning of our company. Galane Gold came into existence through the acquisition of the Mopani gold mines in Botswana, August 2011, and that, when we acquired it, had about an 18-month operating life ahead of it, according to all the numbers. And here we are, almost now exactly 10 years later. And as we've been saying for about the last 5 years, we've got a good 3 years ahead of us. So we transitioned that from an open pit operation to underground about 6 years ago. And we continue to extend the life there. And that's really been sort of the engine that's kept us going over these 10 years and allowed us to now do 2 more acquisitions under our own steam for the most part. And build up the team, and as I like to say, put the band together, and create a company now that I think has an interesting and growing portfolio to really be a levered way to participate in this upcoming precious metal cycle.
Yeah, interesting career, and by taking that year out, you end up here. I wonder where you would be by not taking that year out. How different your journey could be.
I might have a thick pair of glasses on and be teaching calculus somewhere. So I think about it often, like the significance of little decisions, and so many major plot twists in my life and career, as all of us have experienced, have occurred with some guy I met at a bar, or a random person that came into my life that really caused a direction change. So yeah, great question, and I love to think about it myself.
Yeah. So wondering if you can give our audience an overview of Galane Gold as a company, and I suppose more in today's present environment. Maybe backtrack a little bit, and also, I suppose, looking at what you're potentially looking to do in the future.
Absolutely, and let me preface it with I think we have a bit of a different approach. I guess a lot of people say that, but I think their last 10 years we've actually done it, and most of the fruits from that labor are ahead of us. So we'll have to see if this was a good strategy and we've been the right guys to execute on it. But our strategy has really been to look at things from an opportunistic basis and say, look, industry like this, every cycle looks different. And if we look at what worked really well in the last cycle, for golds, let's say starting in 2001, 2002, when it really started to bottom and move higher, the companies that created a lot of value for themselves and their shareholders, a lot of it was like big open pit deposits, that discoveries that were made in the 90s or perhaps even 70s and 80s and were never exploited for a number of reasons. The grade was too low, the jurisdiction was too bad, capital markets weren't there at the time. All those factors combined to have this huge pipeline of undeveloped projects going into that cycle. It was diverse. So they were heap leached, there were low grade, big tons, there were high grade, low tons, stuff all over Africa, Central Asia, former Soviet Union, all sorts of interesting stuff all over the world. And capital markets showed up, the commodity price moved, lots of money was thrown at it, stocks went up, stocks went down, but those assets got developed. And By the time we were hitting the peak of the cycle, that pipeline had really been drained. And despite billions, tens of billions being thrown at exploration, more than it's ever been thrown at exploration, and more technology that's ever been thrown at it, the discoveries just didn't come through the way they did in decades past. So we show up now, you can pick your starting point for this cycle. Maybe it was the bottom was in 2015 or 16. Maybe you'd argue it was 2018. It doesn't matter. We show up at this cycle and that pipeline is tiny. And we look at how are you to create value in this? We think it's going to be a real challenge for the very large producers. They have this, it's always been a challenge for them to replace their reserves and deal with that. But with this shrunken pipeline, they are moving laterally and through M&A as opposed to trying to find particular projects in development or do it organically. Very hard for them. The projects just aren't out there. We can all do the math on that and figure it out. It's a real struggle for them. And so, yeah, they're generating huge amounts of free cash flow now, which is great for the industry. It's great for their shareholders. But are they able to replace reserves? It's going to be a different sort of challenge this cycle. So we've come at it a different way. And I think the first asset that we took on in Botswana is a great example. The mill and all the associated infrastructure that we inherited when we acquired that, you would never build that right now for the scale of the operation that we have. Undepreciated book value of those is going to be on something on the order of $80 to $100 million. The operation this year will do just shy of 30,000 ounces of production. It would be a big stretch to justify it. Maybe you could with $2,000 gold, but if gold was 1,200, you just wouldn't do it. So, but we had it. It was there. It was built by somebody else. That was a legacy asset. Everything was permitted. You have tailings. You have a management team. You have relationships at all the relevant levels of government. It's a living, breathing animal, like a beast that we took on, not a cold start. It was a hot start. It was running, in fact, not a start at all. And there is huge value to that I think in the mining industry more than any other industry that I am aware of, to having all that infrastructure in place. And infrastructure doesn't just mean buildings and equipment. It means all those other things, permits, access to water, et cetera, et cetera. So many moving parts to mining. The value of having that in place is a multiple of what it costs to do it, because you also have time as a huge variable in there and risk. You don't always get things permitted. You don't always and they often do go wrong. So if you've got all those things in place and you're showing up at the end of it, if it cost $100 million to build, it may be worth $300 million because of all the walls of worry and walls of risk that you climb to get there. Financing risk is another one too, of course. It's not always possible to finance these things. So our approach has been, hey, is there some opportunity for us where if we're looking at 300,000 ounce a year open pit projects in a decent jurisdiction, we are not going to get that project. We're not viable competitors for it. We're not going, and if somehow we could, we'd love to have one. We're probably going to have to pay so much for it that is it really going to create value for us anyways? Let's instead, is there an opportunity for us to look at opportunities where it slips through enough cracks that the price is different, the opportunity is different, that we can leverage the existing infrastructure that's available to us, that we can make outsized returns for ourselves. And I think what we've done at our last two transactions, in fact, what we did with our first, exemplifies exactly that. So Botswana was supposed to shut down in 18 months as an open pit operation inside a very big company. Managed like it's a great company. There's nothing wrong with the guys who owned it before. Fantastic people at all levels, but a big company. We take on that operation. It went from about $1,400 to $1,500 an ounce operating costs. We've got that down to about $1,050. And we went out and did the hard yards and extended the life. We discovered 20,000 ounces here, 30,000 there, 5,000 next to the mill. We transitioned it to underground, and that was an operation that's contributing almost most of that 30,000 ounces a year from that underground operation. Just too small for IM Gold or anybody. It was smart of them to sell it, smart of us to buy it. Sometimes transactions are win-win, and that's a great example of one. So we took something, I don't want to say another man's trash. It wasn't trash, but something that didn't fit for somebody else that was a great fit for us. Next acquisition for us, Galaxy in South Africa. What did we do there? 1.5 million ounces roughly resource, but it's in South Africa, which some people will shy away from. Underground, again, some people just want to do underground. Relatively small operation. We're exiting this year at a run rate now that we've got it going of 23 or 24,000 ounces a year. We'll eventually scale that up over the next 3 or 4 years to 50 to 60,000 ounces, but still small in the pantheon of global gold mines. And the final final check mark against it is it's a highly refractory ore. So metallurgical challenges right across the board on dealing with that. But we were able to buy that for effectively a few $100,000 of cash and the assumption of a bunch of debt. And a small share issuance as well to the existing holders. It was a private company that was in financial distress held by South African investors. So what have we done since in the 5 years that we've owned it? Put in a new mill. We expanded the resource from 1.5 million to now 2.4 million ounces, all categories. Huge lift, and we'll continue to increase that. We've put in and added to the main ore body that allows us to continue with the same style of highly mechanized underground mining that we do in Botswana. Exact same mining methodologies. In fact, mostly the same people involved running both. And we've done all that largely under our own financial resources. So primarily with their own cash flows from Botswana and some debt that we've taken on against the South African operation to fund that. We've completed all. We're now actually producing gold, and now we're talking about that we basically took a few $1 million of debt on and have an operation with 2.4 million ounces of resource that this year will produce thousands of ounces, but in the next several years we'll have it up over 50,000 ounces of a year. Huge return for us, company maker. But you could see, not even today with $2,000 gold, most people would not take 2 looks at that asset. Last transaction, very recent, just closed last month. I think you'll appreciate this. Sounds very similar. Bought a past producing mine, underground, mill and facility in place. Went into care and maintenance in 2013 due to the collapse in commodity prices, and the company had too much debt. And one of the lenders took it over, restructured, got rid of all the debt, all the obligations, cleaned up the company from a corporate perspective, kept all the facilities in excellent condition, and put it for sale. But this is an asset that once it's back up and running, which will be relatively soon, we'll do 850,000 to 1 million ounces of silver a year and about average about 15 or 16,000 ounces of gold a year. So you could say on a silver equivalent, about 1.5 million ounces of silver, or on a gold equivalent basis, 24,000 ounces a year of gold. Fantastic, super profitable at today's gold prices. We can be in production literally in 2022. We have the mill, everything's permitted, a minimal capex to restart. But again, how many groups have the ability to operate a mine, especially an underground mine, but also we'll look at something that's 25,000 ounces a year of production? It's too small. But for us, with 30,000 ounces coming from Botswana and scaling up to 56 to 60,000 ounces a year in South Africa, that's a huge contribution for us, and also does some other things for our portfolio. We've loved operating in Botswana and South Africa for the last 10 years, but we're always tagged with an Africa discount, and we're always asked a lot of questions about risks of operating there. Those are two actually great countries to be mining in, particularly Botswana. But it doesn't change the fact that New Mexico, United States, is a tier 1 mining jurisdiction, full stop. So that is a great diversification for us and a great third leg to the stool. But really, it was more, I think the bigger thing for us was we didn't set out to like, let's buy something in America or let's buy something in Canada, Australia, America, get the heck out of Africa. Not at all. We were looking bottom up for what kind of asset and opportunity checks those boxes for us, where we can create huge amounts of shareholder value by de-risking it on the timeline, on the risks of things like permits, which are just going, that risk is just going up and up and up with the more focus on ESG and environment, and do something where we can do we cover most of the financial requirement under our own steam. So half of the consideration for the asset and all of the capex required to put it back into production, we're comfortable we can fund off our own balance sheet. So if that was a 300, again, we'd love a 300,000 ounce a year open pit operation in Nevada or some great place like that. But if we had something like that, it would be a huge financing task. We'd be up to it, and that'd be great. But this is one where the financing is de-risked. We don't have to go to the market. We don't have to worry like, are they going to be there for us? We can deal with that under our own steam and just take that huge risk factor right out of the equation. And that's really what our focus is as a company. The other thing that maybe led us to that, our capital structure is quite different. We were almost 60% owned by insiders and immediate family members. Now that's below 50% with a little bit of dilution around this transaction. But I don't know this for a fact, but I would say we've got to be of any public mining company, certainly one that's in production, we've got to have the highest or very close to the highest insider ownership component of any such company, and that governs our thinking. Doesn't mean we're always going to be right. We may make mistakes going forward, and we certainly made them in the past. But you certainly know where our motivation is. Our motivation isn't to get a better salary or order a fancy wine at company dinner. It's to create value for ourselves, and not in the short term either. It's not like we could see any liquidity in our personal investment. This is a 10+ year time frame for value creation, and that's governing all of our decision making.
Yeah. I take it obviously you're out looking at M&A at the moment, and obviously for the foreseeable future. What would you say your main criteria is when you're analysing a project? And I suppose looking at your top 3 criteria maybe in order, that you would, when you're analysing a project, what are the top key 3 attributes that you look for on that particular project, and what you have done in the past to move forward with the assets that you have purchased?
So number one is it accretive? So if it was 10,000 ounces a year of production on the far side of the moon, but it was going to be hyper accretive to shareholders, it made it past the first hurdle. Then I'll give you a specific example on that one. We saw 2 assets in the last several months, which were in the United States, in many ways similar to the Summit mine that we just bought, except larger resource, potentially more production. But so at first glance, they look like more attractive opportunities with more upside and more bang to it. But when you run the numbers and look at the capex required, and the execution risk around it, and the time required to put those into production, even though at first glance they look very similar, the NPV, the net present value of the cash flows that we believe we could derive with those base case plans that we looked at for each of those, it wouldn't have been accretive. Maybe if our stock was trading at 10 times what it is today, other stuff becomes accretive. But that's hurdle number 1. Hurdle number 2 is risk. So for, I think, almost everybody involved on the senior team at Galane, I could certainly speak for myself, it's our main asset in life, our ownership in the company. So our base case is always to do nothing, status quo. And for example, we could have just stuck with Botswana and South Africa, particularly our Galaxy operation in South Africa. I mean, we could really see that producing gold for decades and decades. And we've gone through the hardest part of re-permitting it, putting in a new mill, putting in the big adit to get to the new ore body, and we're in production. So, you know, we could coast off that and probably coast for a very long time, and that wouldn't have been so bad. So that's always the base case. Is the easiest thing to do is nothing, and it's often the safest thing to do. It's not our first choice, but we have to compare everything against the baseline of what if we didn't do anything. So risk is always a factor. We are not afraid of jurisdictions. Most of the management team, the CEO and CFO and myself, spent significant parts of our career working in the Congo, for example. I've also worked in Liberia, Iraq, challenging jurisdiction you can name. I've probably been there and done something on a professional basis. And much of the management team is like that as well. So those are all opportunities we will look at, but they are risk weighted. We will do something in New Mexico before we're going to do it in Mexico. It's as simple as that. But so that's definitely criteria number 2. And number 3, I'd say, is how does this fit within the company? And the most important parts of that are financial and people. So we are, we're a growing company. Depending on commodity prices this year or next, we're going to cross the 100 million a year in revenue mark. But we're still small. We have a CEO, we have a CFO, a COO, one chief geologist, now spread across 3 assets. We're lean and mean, we're as lean and as mean as one could be. So we really do have to seriously consider, okay, how do we staff a new opportunity? Can we use existing resources, or is it totally new? Are we inheriting a team when we buy this? How does that fit in on a people basis? And we really have to, there's only so many hours in a day and so many days in a year. And when assets are here and there, you got to factor that in. The other question mark about how does it fit in the company, and I talk about that criteria, is financially. So for example, we bought this asset in New Mexico, and we have a contingent payment on commercial production. We also have some CapEx that we have to do there. We also have some additional exploration we want to do above and beyond that CapEx. So what does that mean for us as a company and our shareholders? Does that mean, do we have to go to the market? Doesn't mean that's a bad thing. Maybe that's a great thing. But we have to understand, what does it mean to the company? And again, going back to criteria number 1, is it accretive? That's a big part of thinking about that. So if you ask me, what are the first 3 hurdles you got to jump over? Number 1, is it accretive? Number 2, do we understand the risk and do we accept the risk and we can manage it? And number 3, how does this fit with us as a management team from an HR basis, and then also on a financial basis?
Yeah. Obviously, you're from the finance background, and you mentioned, obviously, going through your career, you weren't necessarily involved in gold, but then you came across gold and you continue to learn about gold as a asset. I take it then you'd be interested in macroeconomics, currencies, etc. So I wonder if you can just give us an overview of what you've learned, what you've developed, and I suppose what's happening in the world today. And also, I suppose, how we can actually protect ourselves. I've gone through a similar journey myself, because I've been involved in the mining industry from a recruitment perspective for the last 11 years. And it's probably only the last year and a half that I've actually got my, I suppose, fingers into understanding a lot more about the mining industry. Obviously, doing mining podcasts like this and speaking to a variety of different people, my knowledge is now really getting more extensive. And obviously, I follow a number of different people around the macroeconomics, around various, obviously, precious metals, and understanding finance a lot more than what I did 18 months ago. So yeah, just wondering if you can give us an overview of your learning, and I suppose what is happening in the world today around the whole financial markets globally. Yeah, just wonder what you can tell us and what you've learned.
And I think that's a great question. The first comment I'll make is I'm still learning, and I think I would put out there that this is a chaotic and complex system. If I go put my mathematician's hat on, and we have this impression there's somebody behind the curtains pulling the levers and pushing the buttons, but they are not magical people with godlike powers. They are people with lots of education, experience, access to information, and they also are trying to figure it out too. And they are also making lots of mistakes. They're also maybe acting with the goal in mind, which may not be consistent with exactly what they're saying. And let me take you a bit on my, because I've had probably a different journey than most on it too. With the family office that I joined and the company I ultimately became CEO of, I had a great privilege and opportunity to work with some great macroeconomic minds. So on our advisory board, we had Paul Volcker, former chairman of the Fed, Dr. Sidney Jones, former deputy secretary of the Treasury in the United States, Ken Curtis, former chief economist, Goldman Sachs Asia at the time, vice chairman of Goldman Sachs. And directly in my office for 12 years, I had the great pleasure of working with a gentleman named John Crow. And Mr. Crow was the governor of the Bank of Canada. And prior to that, I believe deputy head of the IMF, very senior roles throughout global macroeconomic organizations. So great opportunity for me to learn. I still, with all that, was not enamored of gold. And I've continued to have a great access, to learn from people like this over the years. But I can say from working firsthand directly with these people for many years, they are brilliant, and they have they're just absolutely big-brained, accomplished, amazing people with a huge amount of knowledge that should not be disrespected. But like I said, they do not have godlike powers of premonition and projection, and they do not fully understand what's going on either. And I think that's an important premise for anybody trying to wrap their head around this. So back to your question of, what's your thought? What do you think is going on here? I think, again, because it's a complex and chaotic system, to use a mathematical vernacular, I think you have to keep it as simple as possible in trying to come up with any conclusions. And for me, the most simple conclusion is, since really going back now 50 years since transitioning from what became the failed Bretton Woods system into the sort of floating rate currency system that we've been on for half a century now, and then accelerating in a very meaningful way with the advent of the financial crisis and a bunch of factors coming to a head in 2007 and ultimately 08, 09, we have been binging on debt. And the theory is, simply put, we could smooth the economic cycle. Won't be so great at the top, won't be so painful at the bottom, using all these monetary policy tools, concocted mostly from guys with PhDs in economics from Yale. but that's the theory anyways. In practice, it's totally not worked at all. There's no evidence to suggest that's worked. What the evidence suggests is it's really benefited a very small percentage of people, myself included, by the way, in a massive way, and hurt over 99% of other people. And then the retort might be, well, trickle down economics, again, another tangent for another day. But that evidence has suggested that is false reasoning as well. So we've binged on debt. In theory, it should not be a bad thing to use debt to smooth over the cycle. You're bringing some growth that you would have had, or in the future, you're pulling it forward using financial engineering to smooth out some tough patches. But politics comes into play, and nobody likes tough patches. Nobody likes down. We like up. We like good times. We like roaring 20s. We don't like 1929s or Depression 1930s. So let's just try and avoid those altogether, and let's have good times all the time. And that's certainly what politicians would like. Politicians who'd like to get reelected, they don't want any bad times. And so the very simple conclusion I have is we've taken on a lot of debt. The transition to a completely floating rate system anchored by nothing but the good will and sensibility of the U.S. government and the policymakers in the United States has let us do that and really facilitated it. All the financial engineering and instruments we've come up with over the last many years have facilitated it. And the situation we have now is mathematically intractable. So we can point to, well, we came out of World War II and we had over 100% debt to GDP in the United States. Yes, true. And there are some parallels then. There are some things that are so completely different though as well. So it's hard to use that as a useful comparison case as us coming out of this time. So what was happening then, you had almost all the debt was owned internally. So it was the United States lending to itself, people lending to the government, people lending to businesses, businesses lending to government. Where that's changed in the last 50 years is you have this huge foreign component of outside ownership. We went into this huge demographic boom post World War II. We also went into a huge peace dividend. We also had any number of other positive factors, huge productivity boom through continued industrialization and mechanization, advent of computers. All that just kept pushing us forward in fantastic ways. Those are factors that those are tailwinds we just don't have now. In fact, most of those are reversed on us. They're now headwinds for the most part. Japan's a great example of the demographic boom turning into a demographic bust. And that is what's ultimately ahead of us in every country, some sooner than others. So we don't really have the same playbook. We can't run the same playbook that got us out of that huge debt position exiting World War II. What the playbook that I think we're running, which is maybe the single most important thing to understand for our investment portfolios, whether it's your real estate, your bonds, your gold, or your equities right now, is what playbook are the central bankers running? What is the exit path from the debt situation that we're in? It's inflation. And watch what I do, not what I say, kind of thing. But they've changed the narrative. It is what they're saying now too, is we need inflation. We're going to continue to support inflation, and we're getting inflation. And inflation is the way out of the debt problem. And I go back to and the response to that may be, yeah, but surely they know that the continued significant inflation is going to really hurt a lot of people, a majority of the people, in fact. And I come back to a Star Trek reference there, which some people may be familiar with, others not. And the reference is called the Kobayashi Maru. And it's a scenario or test where it's really testing how do you behave or what do you do in a situation where every choice you make is going to be a losing choice. It's a question of how do you lose? Like, what do you do in a lose-lose scenario? And I think the lose-lose scenario here is, well, we could default on the debt. That's not a very good choice. The utter collapse of the system and the world as we know it. The U.S. simply cannot default on its debt. It is, in a financial sense, the end of the world. They can't confiscate debt, so cancel the debt owed to China or to Japan or whatever. It's equivalent to defaulting. Total destruction of the financial system as we know it. We can hope for the best and hope that productivity gains and the internet and artificial intelligence and the good people's hard work will just grow us out of the debt and maybe throw in a little bit of austerity there and stop spending so much. That could work, but as I said, I would consider that mathematically intractable situation. It is not everything's possible. It is not plausible. That is not a scenario that any sane person would try to work towards. It's just not possible at this point. So that leaves you in this Kobayashi Maru lose scenario, with trying to inflate your way out. And I really believe that's our global playbook. That's what the central bankers are running to. That's what now the treasury departments or equivalent of major economies, certainly in the EU, the United States, and Japan, are playing towards in concert with their own respective central banks. And that's investable. We can work with that if we work with that premise. And in that premise, I would presume that interest rates remain very low, that real rates which are now increasingly negative, will get more negative. Equities, in a broad sense, will probably perform. And one should look at equities that will perform best in an inflationary environment, and definitely some will and some will not. And also look at other assets that will perform in an inflationary environment: gold, precious metals, and real estate, in particular, what I call center. I will use the Canadian term. Apologies. Real estate on center ice. So the high quality, large and liquid, mainstream kind of real estate opportunities. So as opposed to highly speculative fringe stuff. So real assets and ones that will participate in inflation. As to where's gold going to go, I can't tell you that, and I certainly I don't have much respect for anybody trying to come up with a specific target. To me, the conclusion is the direction is up, and the angle of ascent is high. And really, how do I come to those conclusions? My premise about the inflation being the base case and being the playbook for central bankers around the world, and also looking back where it's been. So you had what could be called a blow off top now 41 years ago in 1980 on gold. That was $800. If you take the official inflation statistics over the last 41 years, which I don't put much stock in myself, but it's a starting point, that'll land you for a potential blow off top, if you mark top to top, just inflation equivalent, inflation adjusted equivalent is somewhere in the high 2000s. If you instead look at the expansion of the monetary base over the last 40 years, normalize that against the expansion in the base of gold outstanding, and there is 1 or 2% added to the global gold stock every year through normal course production. Very little of it's actually consumed and depleted. Most of it's on people's wrists, necks, in their safes and in vaults and central banks and so forth. It's mostly still there. So if you take that money supply growth and focusing on the US dollar, normalize it for that gold production, you'll get something like $10,000 an ounce. Both of those numbers are moving targets, though, because inflation is happening and the numbers are getting bigger, even in the official statistics, which aren't very accurate for any of us actually living in the real world. And that money supply growth is just absolutely a rocket ship at this point. So where's gold going? I don't know, somewhere between the high 2000s and 10,000, and that's a moving target, and both moving targets are higher. So gold's going higher, and it's going to go there pretty quickly in my mind.
Yeah, appreciate that. Obviously, that summary. That's great. And again, it's similar to along the lines of what I've been learning as well. So I've got 2 more questions. Obviously, you're an entrepreneur and you've been involved in the mining industry for 10, 15, 20 years. If someone was in a similar position where you started off, what advice would you give them, or any sort of guidance as to what they should be doing, and how did you sort of start and get into this industry and then move to where you are today? What advice would you give sort of your younger self?
So 2 things come to mind immediately. Number one is people. So particularly for me, I don't have any background in geology. I'd never worked directly in the mining business myself. So you need to work with people that have that knowledge and have that expertise. And for again, a combination of reasons. One, it sort of was choked out as a popular vocation for a very long time. The pool of people who have that skill set is diminished. And now overlay that with a hot market in virtually every type of commodity asset. And even oil and gas again has in the face of all this ESG and environmental and carbon issues, almost inevitably started to move up. So all of those are sucking up people. So you really got to find those one or two people that you can trust who really have that domain knowledge and the relationships. Very small, tight knit. I don't need to tell you with your background, but small, tight knit group of people around the world. And I find it funny if I mentioned some of the exotic places I've worked over the years. And it's kind of the same set of people that you bump into in all these circles. So it's often Canadians, often Australians, and people from the UK, and very seldom encounter any Americans outside of America. Relatively few Europeans. It's a very concentrated small group of people operating in these industries. And the further you get from the mainstream, the more concentrated those pools become, and the more you're bumping into the same people. So that's certainly one thing that's absolutely critical. The second one is, and I've repeatedly made this mistake in my career, even in fund management, and then I replicated it in different ways over the last 10 plus years as an entrepreneur starting different businesses, is and it's easy for me to say this now, I guess, because I'm in a good position, but I think it applies to everyone, even somebody starting out. If you're taking something on, make sure it's worthwhile. And it sort of contradicts what I was saying of us like looking for niche opportunities at Galane. But Galane for me really moves the needle. I have a huge position in it. It really makes sense for me to throw myself at it and do everything I can to make it work. And it's worth my while for sure. I've gotten into too many things in my career which have distracted from the main show, and have, even if they worked out spectacularly, which occasionally they do, but mostly they don't, just didn't move the needle. So what did that accomplish? It was time and energy suck, and also impaired my ability to focus on my main show. And so I think if I could go backwards 20 years, I would by a long shot focus more on the people I was with along the journey, just both for success, but also enjoying the ride as well. And number two, make sure I'm focused on things that really matter, and instead do one or two things really well, instead of trying to do one or two things really well and 26 other things when I can.
Yeah,
With
no, I
whatever time I
understand.
can.
Yeah.
And I it's almost daily after, because interesting stuff keeps coming across the transom, and my nature is like, let's do it. When do we get started? But I want to do it
But
all.
there is a time, and it should be more often, to say no, I'm not interested,
Yes.
and focus on what your main goal is. And because, like you said, you're going to get too many things coming to you, and the tendency is to say, yes, I'll take that on, yes, I'll take that, and then next thing you don't actually get anywhere. So you're better off saying no more often than yes.
Exactly. And maybe even rephrase your initial statement there, is like, no, I'm not interested. It's like, I'm really interested, but no.
But not at this time.
I was going to relay also a favorite line of mine, which everyone who's worked with me for any amount of time knows. Hey guys, what if? And then I get a lot of, okay, what's he going to say now? What crazy scheme does he have up his sleeves? But the people who I work with generally have figured out how to humor me on those and manage me through them.
Yeah. So as a conclusion, what's the sort of short and medium term outlook for Galane Gold and also yourself?
For Galane, we've got three pillars to the stool now. Botswana, we're just going to continue to produce. That's a mature asset. That one, the contribution is very much tied to gold price at this point in time. nothing left we can do on costs. Our exploration is really just to keep extending the life. There's no fundamental change on the horizon there. Galaxy, we're still in execution mode, ramp up. So it'll be thousands of ounces this year, going to tens of thousands of ounces in 2022 and onwards. But I think the hard yards are done. We've already sort of refocused our management team now onto New Mexico, the third one, and there are the spotlights on us. So we got to show that we can internally fund it, staff it, and make ounces of gold and silver out of that one as fast as we can. So I think with us executing on those, we continue for the next several years. See a organic production increase in gold. We'll also see starting next year the silver contribution come on thanks to the Summit acquisition. And I think what happens with that is we get more critical mass. We show a larger revenue number. We can get our market cap up there, appeal to more investors at the same time as we start to get on with a more realization of a bull market that's happening in precious metals and what's happening with monetary policy around the world and what it means for gold. We can do a lot for investors. It's a great time to be looking at our company. For me personally, I'm very much focused from a professional standpoint on Galane and also my renewable energy company, which is in many ways quite a different business because it's so low touch with renewables, solar and wind in particular, unmanned facilities. It's not a people business. It's much more a financial engineering business. So it is lower touch, but it's a huge area of interest for me. So something that I definitely want to see continue to succeed and grow. And hopefully do so in really innovative ways like we've done with Galane, interesting jurisdictions, and maybe, again, we can't compete with the giant pension funds and insurance companies who are looking to get 0 to 5% annual yield. We just can't source capital at those kind of costs of capital, nor are we interested in trying to earn that kind of return for ourselves and our shareholders. So we have to be creative, much like the Galane situation. We have to be creative and find our own path to value creation by doing things a little bit differently.
Yeah. Ravi, really appreciate your time and giving us an overview of obviously Galane Gold and giving our audience I suppose some education around macroeconomics and what's happening in the world today. So really, really appreciate your time. If our audience wants to reach out to you, if they've got any questions, how can they go about doing that? Are you on any social media channels?
I am not personally active on social media other than LinkedIn, where I'm easy to find and message, or through my corporate email, Ravi, R-A-V-I, @galanegold.com.
Okay. Yeah, no worries. We'll include those in the show notes accompanying this podcast. So really appreciate your time again. Those that are listening, hopefully you've learned a lot. I certainly got a few points that I'm going to take away. And obviously a company, Galane Gold, and obviously they've got a lot of other prospects out there, and obviously looking at developing more prospects and acquiring more assets. So definitely a company to sort of look out for. So really appreciate your time listening. Please share this episode amongst friends, family, other people in the mining industry. Again, if you're looking at watching this on the YouTube channel, appreciate if you can like below and share this episode so it goes to all 4 corners of the internet and the YouTube algorithms. So more people can actually listen to this recording. So like I said again, Ravi, really appreciate your time. Maybe come on to the show next year or later this year and give us an update. You'd be more than welcome to do that.
I'd love to. Thank you very much.
Yeah, no worries. And until next time, happy mining.